Hey, ever wonder why people keep obsessing over venture capital at tech meetups, conferences or startup hangouts? It's like they are hunting some rare Pokemon or maybe that Labubu. But is this VC thing just a hype, or is it really the secret sauce behind the next tech giant? Well, you are in the right place. I'm Niklas from spectup and I help companies to raise capital and build them outbound engines so that they can grow and scale fast. If you are now ready to transform your startup's potential into scalable, unstoppable momentum, let's make it happen and keep watching this video. In the next 15 minutes, I'm going to break down everything that you need to know about venture capital. From what it means to why startups chase it. How can it either take your dreams sky high or bring some serious challenges? No jargon, no MBA required. Just clear practical insights so that you can decide if VC makes sense for you. So what is venture capital? You have been running the startup world and venture capital. This buzzword might have come across your mind a few times. Venture capital, or VC, is simply money provided by investors to startups, early stage companies with big ideas that need fuel to grow fast. Imagine you have got a rocket ship. VC money is the jet fuel that helps you to take off. But VCs don't just hand over cash like it's a giveaway. Obviously, no one would give anything up for free. Everything comes with a price. So what do VCs want from you? Money? No, but kind of yes as well. They want a slice of your company called equity. So when a VC invests, you are sharing ownership in exchange for their money, expertise and connections. More rocket fuel, but a little less control. You can summarize it as, unlike traditional loans, VC firms are betting on your big idea and your team's ability to execute it. And they often bring much more than only money. Mentorship, connections and strategic support. So now comes the point. Why do startups need venture capital? And most importantly, who needs venture capital? Obviously not every startup needs a VC. Some founders bootstrap using personal savings or early revenue. But here's when VC shines. You're playing a high-stake game where speed matters. You need to build a killer team and build a complex product fast. You want to break into a competitive market and need resources for that. Ever wonder how venture capitalists seem to always find the next big startup before anyone else? What's their secret weapon? It's called deal flow. The lifeblood of every VC firm. Imagine a non-stop river of hot investment opportunities flowing into the inbox every single day. That sounds powerful, right? Stick around because I will show you exactly how this deal flow engine works and how your startup can stand out and get prior. Simply put, deal flow is the steady stream of startups that VCs see, vet and decide to back. But behind the scenes, it's a finely tuned system working 24/7 to spot the winners before anyone else even knows they exist. The whole system includes market scanning, attending conferences, and following tech news to spot emerging opportunities in sectors like fintech, health tech, or consumer apps. Or other times, just leveraging relationships with entrepreneurs, founders, accelerators, and other investors to get early leads on promising companies. Let me tell you a fun fact. Top-tier VCs might review hundreds, maybe thousands of startup opportunities every year, but invest in less than 1% of them. Guess the goal? To identify high-potential startups that fit their focus area and could deliver outsized return. Here's the kicker. Getting on a VC's radar isn't random luck. Understanding their deal flow process means positioning your startup to be at the front of the line. Warm intros, strong action, and smart timing can turn a cold door into an open one. But to do so, you definitely need a strong pitch. You have seen Shark Tank, the high-stakes elevator pitch that can change a startup's destiny in minutes. But real venture capital fundraising, it's nothing like a quick pitch. Here's the reality. You are diving deep with VCs, walking through a detailed slide deck, covering everything from your product and business model to your market size and team's strength. Forget one and done. This is a marathon, not a sprint. Expect many sessions where you have to repeat what you said all over again. VCs want the full picture. Your product, your traction, your numbers, and yes, your killer team all laid out clearly. Get ready for the grilling. VCs will challenge your assumptions, probe your competitor knowledge, and dig into your go-to-market game plan. So if you are going to say, we are the only company in this market, definitely not gonna work. Show them the proof, bring out the numbers. Don't just tell. I would say bring a live product walkthrough or demo because it fuels credibility. Back it up with solid metrics like growth rates, engagement stats, and revenue projections. Now you might be wondering, I got all of this, but not the story. Will this work? It might work, but the secret sauce of all time is storytelling. Successful founders don't just show data, they make VCs feel the passion behind the product. Find empathy, pain points, connections. It's like connecting the strings to make the fate aligned. Explain why now is the perfect timing to build this company. This emotional connection is often what seals the deal. Remember, it's a process, not a performance. Unlike the TV show drama, VC deals often stretch over multiple meetings with different partners, diving into technology, financials, market fit, and more. The next most important and primal spot is due diligence. It's after they have dug deep like detectives, hunting down every clue about your business. This intense process is called due diligence, and it's where the real challenge begins. VCs don't just look at your numbers. They deep dive into your revenue streams, asking, where's the money coming from now? And where will it come from tomorrow? They measure your burn rate closely. How fast are you spending cash to fuel growth and profit margins? They want to know if your model can survive the long haul. Not only that, it's not only the product, it's also the people behind the company. Investors check founders' backgrounds, hunting for relevant experiences and wins. They assess if your team has the right skills to pull off the plan and even if your culture aligns with their investment philosophy. Because a great team can pivot and thrive. It's more like you need the best crew to make a plane safely arrive on destination. Else, it would not reach the milestone. But to have the milestone achieved successfully, you need to see how big is your price, total addressable market, or TAM. VCs look for huge opportunities and growth trends. Plus, they dive into your competitors to understand your position in the fight for market share. So make sure when you are pitching, pitch for everything. Regulatory hurdles, operational bottlenecks, and unpredictable market shifts. Red flags before they become roadblocks. Patents, trademarks, contracts. This sounds exhausting, right? It all boils down to just one thing: minimizing their risks while maximizing the opportunity to make a big return on their investment. But don't worry. We have backed up many startups who raised from VCs, and I also scout directly for a few venture capital firms. Some weeks ago, we even booked Google Ventures and Sequoia for one of our clients. If you are currently raising and you look for professional support for the investment strategy, for your investor materials, or for the outreach, then go to our website spectup.com and send us a form, and I promise me and my team, we will get back to you in probably 24 hours. Now, coming to the point when you should know VC investment is not like taking money and done. It comes with potential risks. It's like different flavors of chili depending on your company's life stage. Pre-seed and early stage. High risk, but if you hit, returns can be massive. Think 100 times or more. Growth stage. Less risky since the company's proven, but the returns are smaller, maybe 3 to 10 times. Agnostic. Some VC firms invest across all stages balancing risk and return. But here's the kicker. VC returns usually take 7 to 10 years because they have to wait for an acquisition or an IPO so that they can exit. So patience is part of the game. We talked about pitch, we talked about who needs VC and why they need a VC. We also considered the risks and how vetting is done. Now the question arises. A founder is doing everything. Team is supposed to back up. But what do you do all the day? It's far from lounging around. If everything checks out, you enter negotiations, hashing out how much VC money comes in and what slice of your company they get. But here's the secret most miss. Post-investment, it's not just money. VCs become partners. They sit on your board, open doors, advise you and help you scale faster. Due diligence can be intense, but it's the foundation of a strong VC partnership. Nail this phase and you are on the path to growth with seasoned by your side. They constantly meet entrepreneurs and scout for startups. They analyze business models, accounting books and market size. They help startups with hiring, strategy or fundraising. But most importantly, senior VCs spend a lot of time convincing limited partners called LPs, like pension funds and endowments, to invest in their funds. The pace is fast, hours are long, think 60 to 80 hours per week, and success depends on creativity, deep networks, and hustle. Now, coming to the next point. Everyone thinks VCs have tons of startups begging for money. Truth is, there's more money chasing fewer great startups right now. So VCs actually compete with each other to invest in the best companies. That means startups often have the upper hand if they are top tier. Top startups frequently receive multiple term sheets from different venture firms. VCs race to build relationships with founders early, sometimes before companies even start raising funds. To win deals, funds may offer better terms, such as higher valuations or fee-friendly clauses, like greater board control or faster access to capital. This flips the traditional power dynamic. You will see founders negotiating tough and shopping around for potential partners. VCs now differentiate not only with capital but also with operational support they provide to the startups. VC firms invest heavily in their branding and reputation to stand out as a must-have investor. Markets deals can close in days, not in weeks or months. VCs must move quickly through the due diligence and decision-making process, or they risk losing this opportunity. Let me give you a super quick fact. According to industry data, some of the most interesting startups can receive over a dozen offers within a week of announcing their funding round. Feeling pressure? Don't worry, we have got you covered. We are here to help you raise with speed, founder and investor relationships and the ability to offer more than just capital. Before you chase VC money, ask yourself these questions. Are you okay giving up part of your company? Can you handle being scrutinized? Do you believe your business can scale rapidly? If yes, VC could be your launchpad. If not, maybe look for other funding routes like bootstrapping, angel investors, or crowdfunding. That was all for the startup founders raising money. But if you are the one having the money, or you just came across the thought, I want to be a VC, here is the typical analyst, associate, vice president, partner. Most come from investment banking, consulting, tech, or even founding startups themselves. And the pay? It's insane. Analysts earn about 60 to 100k, but no carry profit share yet. Partners can earn millions from plus salary. It's high risk, high reward, just like the startups they back. So let's be clear why you should be a VC. Why not? Here are some pros. You will be getting independence, learning about cutting-edge tech and trends first, building strong, influential relationships. But again, everything comes with a price. The cons might be dominating pros. No routine, unpredictable, can be stressful. Can you take that? You might wait years until you see returns. Intense pressure to back winners in a very competitive market. So if you are dreaming of working in venture capital, the best way is often through investment banking or consulting first, building the skills, networks and credibility to make smart bets. So here you have it. Venture capital is not just a buzzword. It's an entire ecosystem shaping the future of innovation every day. Whether you want to raise VC money, work in VC, or just understand what goes behind the scenes, it's crucial knowledge for any entrepreneur. Remember, attracting VC money isn't just about the cash. It's about building lasting relationships, trust, and shared vision. So grab your coffee and start thinking about the kind of journey you want.